Right now, the accepted narrative blames our inflation problems on conflicts in the Middle East. It's a clean story with an easy cause and effect. But inflation in the United States used to move like a pendulum, swinging up, swinging down, and eventually coming to rest in the middle. Today, that pendulum is swinging wildly off-center, and a 5-month-old geopolitical story doesn't explain a 5-year-old economic problem. To understand the actual timeline, we have to look at the Federal Reserve's own internal scoreboard. They don't use the headline inflation numbers you see on the news. They use the Personal Consumption Expenditures Index, the PCE, and they manage the entire U.S. economy to hit a strict 2% target. This chart plots that 2% target line against the Fed's actual inflation data. As you can see, the inflation line soars straight past the threshold. The Federal Reserve has missed its target for 63 consecutive months. That is over 5 years straight. Right now, the PCE sits at double their stated goal. This 2% baseline anchors the entire American financial system. It directly dictates the price of your everyday life. Every rate you pay is priced off what the market expects that number to be, from the mortgage on your house to the loan on your car to the yield sitting in your savings account. And here is the immediate contradiction. The Federal Reserve has spent years aggressively pulling levers to drain cash out of the economy. Yet the total M2 money supply, the actual cash within arm's reach of the system, is currently growing at its fastest pace since July 2022. The geopolitical headlines ignore a deeper reality. The tools usually used to stabilize the ground are failing to hold it. To find out why, we have to look at the last time this machine actually worked. In the late 1970s, inflation accelerated into a sprint, peaking at over 13.5%. The dollar in your pocket was rotting while you held it. Enter Paul Volcker, a man who famously looked like he ate recessions for breakfast. Volcker took over as Fed chair and executed a brutal, deliberate strategy to kill inflation. He drove interest rates to 20%, deliberately triggering back-to-back recessions. He strangled the money supply until inflation simply had nothing left to feed on, driving it all the way back down under 2%. The obvious question is why the Fed doesn't just run that exact playbook today. Volcker had one massive mathematical advantage. In 1980, the U.S. national debt was only about 25% of the total gross domestic product. The debt was small enough that the country could absorb the damage. When Volcker raised rates, it acted as a clean, highly effective brake on the entire economy. Today, the math is entirely different. The national debt has ballooned to roughly 100% of GDP, a 1-to-1 match with the size of the entire American economy. In 1981, economists Sargent and Wallace predicted exactly what happens in a high-debt environment. They warned that when debt is this heavy, raising interest rates presses down in 2 different places at once. First, you have the brake. Higher rates successfully make borrowing more expensive. Auto loans and mortgages price people out, and economic activity slows down. But underneath that, you have the gas. Higher rates simultaneously force the U.S. government to pay massively higher interest on the mountain of debt it already owes. That accidental stimulus is enormous. Net interest on the national debt is now running over $1 trillion a year. That means 19 cents out of every single tax dollar collected is eaten instantly by interest payouts. This $1 trillion payout flows directly into the accounts of pension funds, banks, and foreign governments. These investors immediately inject that cash back into the financial system at the new, higher yields. The Federal Reserve is trapped in a mechanical paradox. The heavier the national debt gets, the harder that second foot pushes. Every time they press the brake to destroy inflation, the sheer weight of the debt forces them to step on the gas. The Fed is now structurally out of runway. They can squeeze the cash side of the economy, but they have no authority to shrink the total size of the debt. They are merely postponing inevitable inflation to a later date. While the Fed manages interest, the primary driver behind this money printer is continuous, unchecked deficit spending on Capitol Hill. Lawmakers secure their jobs by campaigning on promises, and nobody builds a lasting political career by promising voters less. The entire incentive structure points in one direction, which has resulted in a quarter-century of unbroken structural deficits. When asked how to fix this, Warren Buffett offered a thought experiment to forcefully realign these political incentives. His 5-minute solution is to pass a law stating that any time the national deficit exceeds 3% of GDP, all sitting members of Congress are legally barred from re-election. He laughed when he said it, but the underlying math demands an outcome that isn't funny. The more we borrow, the more interest we owe. The more interest we owe, the more we have to borrow. Until the incentive structure in Washington changes, this compounding debt snowball guarantees that the inflation problem will only get worse.
The government's debt trap is visible in every headline, but there's a second, much bigger debt crisis being deliberately hidden from public view. This year alone, big tech is on track to spend more than $700 billion building out artificial intelligence.
This year alone, big tech is on track to spend more than $700 billion building out artificial intelligence. As you can see by the physical scale of the hardware NVIDIA's Jensen Huang is presenting here, that money is being funneled into the largest infrastructure build-out in human history. On the surface, these companies are the safest borrowers on Earth. Wall Street sees a group with massive earnings and only about $1.35 trillion in reported debt, a combination that makes their credit ratings nearly bulletproof. Safety is being eroded from the inside. For the last decade, these firms reinvested 40 cents of every dollar earned. This year, that figure is hitting 94%. The AI build-out is now consuming almost every dollar of cash their businesses produce. The need for cash has become so immense that the US dollar market, the deepest capital pool in existence, can no longer absorb the volume of debt these companies are issuing. They have been forced to look international, raising billions in foreign currencies across 4 different continents in a single day just to keep the project funded. The pace of this borrowing is now a matter of global financial stability. Senior officials at the International Monetary Fund have begun flagging the trend, worried that major tech firms are leveraging themselves at a rate the market can't sustain. Beyond the visible loans, there is a hidden layer. A recent study found just 5 tech companies owe an estimated $1.65 trillion in obligations that never appear on their public balance sheets. The $1.35 trillion of reported debt on the left is now completely eclipsed by the $1.65 trillion shadow pile on the right. In just a few years, this invisible debt has grown larger than the debt shareholders actually see. Coordinating a $1 trillion disappearance requires a sophisticated system of off-balance sheet vehicles, a method of financial engineering designed to keep massive liabilities invisible to the public. To see this system in action, we have to look at a site in rural Louisiana called Hyperion. It is a $27 billion data center campus built specifically to house Meta's proprietary AI hardware. Meta designed the site, Meta operates the site, and Meta is the only tenant it will ever have. Yet legally, Meta does not own the building or the debt used to build it. The facility is owned by a separate entity called Beignet Investor, a special purpose vehicle. A private investment firm called Blue Owl Capital puts up 80% of the equity, while Meta takes the remaining 20%. Beignet Investor then borrows $27 billion from the bond market to fund the construction. Meta moves in as a tenant and pays rent to Beignet, which uses that cash to pay back the bondholders over the next 25 years. By capping their ownership at exactly 20%, Meta ensures they are not classified as the venture's primary beneficiary. Under current accounting rules, this allows the entire $27 billion loan to be legally erased from Meta's balance sheet. The truth about who is responsible for that money is buried deep in the footnotes of Meta's annual report, under residual value guarantees. This guarantee is a legal promise to the bondholders. It states that if the data center is ever worth less than a specific floor price, Meta is responsible for paying the difference. Because the facility is built around Meta's own unique hardware specifications, it has limited value to any other tenant. If Meta ever walks away, the building's value could collapse, leaving Meta legally bound to write a multi-billion-dollar check to cover the loss. The structure allows Meta to sell 2 contradictory stories. To Wall Street, they claim the $27 billion debt isn't theirs. But to the lenders, Meta promises to cover the entire tab if the facility fails to hold its value. This isn't a one-off experiment. Lenders are already marketing a sequel called Project Sophia, a $12 billion bond sale for a new Texas data center using the exact same template. The industry has standardized this structure with terrifying speed. Across the 5 biggest tech giants, off-book exposure has grown 8 times over since 2022, totaling more than $1.8 trillion in invisible obligations funded by the same small group of lenders. This is the return of the shadow banking system. In 2007, economist Paul McCulley stood before the Federal Reserve at Jackson Hole and warned about an unregulated network of investment vehicles that borrow and lend exactly like banks, but without any of the safety nets. The systemic risk today is identical to the one that preceded the 2008 crisis. The only difference is the collateral. The global financial system has swapped subprime mortgages for AI data centers. The AI boom is no longer just a technological shift, it is a highly leveraged financial parlay. It is a bet where 4 high-risk legs must all hit simultaneously for the system to remain solvent. First, AI revenues must multiply exponentially to match the spending. Second, the returns on cloud investments, which are already sliding toward 10%, must somehow reverse their downward trend. Third, the shadow borrowing window must stay open to cover a massive $1.5 trillion funding gap over the next 3 years. And fourth, the American power grid must physically absorb the unprecedented energy demand of these sites without collapsing. If even one leg of this parlay fails, the shadow debt structure will collapse. At that moment, $1 trillion of invisible liabilities will transform into a very visible and very real economic catastrophe.